Good morning, afternoon, and evening. Welcome to Lamb's Cryptoverse. Today I want to talk to you about some questions I've been getting about a recession. The 2 quarters of consecutive declines in the economy. That's not the recession I'm looking at. I'm actually going to agree with Biden on this one. I think this is not a real recession. It's a technical recession because the labor market's really strong and the GDP numbers were affected by trade and inventory. So this is not the recession I'm looking for. What I'm looking for is going to happen later in the year, and it's going to be a authentic recession, meaning there's going to be a lot of people out of work, and people are just not going to be able to afford to buy things because of inflation, and even wages are going to be coming down. So that's the recession I'm talking about. And we haven't seen that yet because the ISM index is still pretty high, very high actually. So I wanted to talk to you today and show you on my screen actually. I think I'm going to hide behind the screen and just show you all the data that's coming out. The first one is today is consumer spending. It rose 1.1%. And so again, we have another strong number. And this number, but remember, this number is not adjusted for inflation. So if you adjust it for inflation, it's actually somewhat weak, but still is one of the highest numbers of a consumer spending since the late 70s and early 80s. And that's not a coincidence. That's because we had a lot of inflation back there. And like I said, this is not adjusted for inflation. So the nominal consumer spending number is going to seem high. So let's go over the economic data we've seen in the last few weeks. We've had strong retail sales, strong durable goods, a high PPI, high CPI, a very strong labor market, and most recently, as I've just mentioned, high consumer spending of plus 1.1%. And associated with that number, we've got the Fed's favorite inflation indicator, which is called the PCE, and that was up 6.8%. So every data point is saying that the Fed needs to continue to be hawkish and they need to keep tightening. And early in the year, the market was doing, the capital markets that is, stocks and bonds were doing the Fed's work. Interest rates were rising and stocks were falling. Now we have the opposite. So the capital markets are not doing the Fed's work. So this puts the Fed in a tough situation. The Fed has no choice but to raise rates, especially since the rising stock market is loosening liquidity. And that's not what the Fed wants. The Fed wants the markets to crash, and they want the economy to go down, and they want market rates to be high. They're not going to tell you that because politically they cannot say that. The only other thing I want to mention today, and I'm going to show you in the charts, is that my indicators have moved from bullish. They went to bullish around between June 10th and June 13th, let's call it that. They went bullish. All my indicators went bullish. And now they're moving towards neutral. So I'm going to give you some example of what these indicators look like. The first one is to put the core ratio. We're at 0.67. In early June, we hit a fairly high number around 0.8 something. 0.8, anything above 0.7 is good. This is a contrarian indicator. And if you look at the fear greed indicator from CNN, we're at 42, but it's gone up. I'm going to hit the timeline, and you could see in mid-May was down to 8, and as a contrarian indicator, that was a buy. But now we're moving up towards what I would call neutral, because we're around 42, something like that. And if we hit 60 or 70, that would be bearish. And now I could talk to you about the crypto market, because the crypto market has its own version of that fear greed index, and that's called the alternative.me fear greed index, and this has moved up to 39. It was as low as 6, and that was a really bullish number. And I'm actually going to get a few right here. If you look at the 1 year, you could see it was low around 6 in June, and it's moved up towards 40. So that's pretty good. I'm going to go hit max here. Well, it's not working, but basically, if it was working, you could see that it's been much higher. So this is a neutral number, even though it's gone up quite a bit. And this is another version of that, but this looks at social media. This is another version of that fear greed, but it's looking at social sentiment based on Reddit, Bitcoin Talk, and Twitter. And this index was as low as 0, and it's moved to 0.34, as you can see on the left side here. That number is 0.34. So I would call this a neutral number. And lastly, or second to last, is this percentage of stocks that are above the 200-day moving average. This is like a long-term indicator, and you can see it's moved up from 15 all the way up to 30. It's more than doubled, and this is because energy prices have been doing well, and energy stocks have been rising as of late. Energy stocks have had the biggest gain today in many months because they reported strong earnings. The big energy companies like Chevron and Exxon have reported strong earnings. And lastly, I wanted to show you this here. This is a little difficult to read, but it's a Buffett indicator, and it shows you the market cap of corporate equities to GDP. And it's pretty rare, maybe impossible, maybe it's never even happened for the stock market to go on a bull run, a new bull market from this level. We're at 214%. That's really high. During the 2008-2009 bottom, we were down to 66%. And during the 2002 bottom, we were around 70-75%. And during the 1980s, we went down to 32%. And we were down here to the 33% level in the 1950s. Look, I don't think we're going to go down to the 30s level, but I think it's reasonable to start a new bull market around 100%, 120%. I think that's a reasonable level given the long-term low interest rates. So that's all for today. So I just wanted to say thank you all for listening, and just be disciplined out there because the markets are going up. People feel like, oh, I've got a lot of cash. I'm missing out in this market. Maybe I should employ some cash. And actually, this is not a good time. A few weeks ago was a great time to employ cash. Right now, you should start thinking about slowly selling because the market's going to be topping out really soon. Well, thank you all, and please hit the like button and subscribe.